Good morning, everyone. I'm Grekou from the CEPI, which is a research center in Paris, focusing mainly on trade and macroeconomics. I'm very happy to open this session with this paper, which is a joint work with Leslie Massoun and Valérie Mignon. As you already guessed with the title in this paper, we try to link the choice of the exchange regimes, which is basically speaking whether the currency freely floats or whether the currency is fixed. So we link the choice of the exchange regimes to the industrial development. And our main point in this paper is that fixed exchange regimes is associated with a negative cost, especially for developing countries. As you already know, issues related to industrialization, both industrialization or reindustrialization, have recently gained renewed interest in both academic and policy circles. Motivations are manifold, but mainly related to the success story of some Asian countries like China, South Korea, or Taiwan. So in advanced economies, issue of reindustrialization emerged, mainly articulated around the notion of strategic autonomy, in particular, given the ecological transition. In the developing world, instead, the example of this Asian country is definitely viewed as the way forward, as the best example of industrial-led economic development. In another context, in particular, which is very relevant for African economies, as you can see on this chart where I summarize the broad OCA, optimum currency area literature, you can also see that industrialization is the key to significantly enhance economic integration, namely through to increase trade among African countries, or at least to create a regional value chains. So benefits of industrializations are known since the early literature, when almost all the papers agree on the fact that industrialization is one of the most decisive factors for economic development. Over time, the empirical studies confirm this view, mainly putting forward different transmission channels, mainly three. The first one is productivity gains, innovation, technology updates, not only limited to the manufacturing sector, but with very significant spillover effect to all the other sectors. The second great transmission channel is the greater macroeconomic stability, thanks to the pro-employment nature of industrializations, the higher aggregated demand, and also another very interesting feature is that with the increase in manufacturing, the economy tends to diversify, which is very positive, given in the case of developing country, the strong reliance on commodity exports. Finally, in terms of development goal benefits regarding poverty reductions and inequality reduction are also being put forward by a number of institutions. Yet, despite these promises, very few countries in the developing world have been able to increase manufacturing share. And despite a very strong political commitment, starting with the initial import substitution industrialization program to more adaptive strategies under the Washington Consensus era. Where the contrary, a large body of study tends to highlight premature deindustrializations, which is a declining share of manufacturing occurring at the lowest stage of development. Deindustrialization per se is natural. As you can see, the manufacturing share increase in the first phase, then decrease to the benefit of services. What is worrisome instead is the fact that this decreasing trend, so the second phase, occur much earlier than experienced in the past. And this is worrisome because it would significantly halt the growth momentum by depriving the country from the channel for which rapid growth occurred in the past. So deindustrializations, broadly speaking, whether they reflect industrialization failures or premature deindustrialization, have also received some attention in the literature. Among the factors explaining these deindustrializations, the quality of governance and institutions have been put forward, not only in the definition of sound industrial policy, but also to counter government and market failure. Another strand of the literature mainly argue in favor of structural reason, in particular comparative advantage. I'm not a big fan of this literature because simply comparative advantage are not exogenous. And a last strand of the literature also focus on globalization, in particular the trade reform and the structural adjustment plan to explain the industrialization in the developing world. In this paper, we argue that the choice of the exchange rate have a very significant impact on the industrializations, especially in developing a country. This assertion rely on two sets of arguments. The first set of argument is related to the very nature of the fixed exchange rate regimes. So by definition, the fixed exchange rate regimes is the absence of exchange rate volatility vis-a-vis the reference currency. So by mechanically, this absence of volatility annihilates the expenditure switching role of exchange rate change. So simply put, price of imported goods from the reference currency, from the reference country are stable, which tend to exacerbate the competition between the local market and the local producer and the foreign producer based in the reference country. Given the low relative productivity in the country that peg its currency, and the lower transaction cost effect associated with fixed exchange regimes, imports from the reference currency, the reference country, put a squeeze on local manufacturing. The second argument is that fixed exchange regime is also associated with a number of constraints, namely fiscal discipline and inflation control. So this constraint heavily weighs on the financing capacity to initiate or to sustain industrialization in this country. And finally, the third point is that fixed exchange regime are associated with very limited adjustment capacity to shocks. The proposed narrative quite fits well with the big picture in the literature on the causes of the industrialization in the developing world. So in the broad line, the augmented story is as follows. As developing countries were strongly encouraged to open up to trade, namely to remove trade barrier and to put in place structural adjustment program, the industry, while still in its infancy and essentially aiming at substituting import, were entering competition with that of country with strong comparative advantage or more mature industry. From this point, fixed exchange regime tends to exacerbate the constraint and the import from the reference currency with more quality, probably lower cost, tend to put a squeeze again on the local manufacturing sector, which became unsustainable, leading to deindustrialization. So in this chart, we give to the fixed exchange regimes a catalytic role after globalization, or let's say in the globalization era. But we can also argue that the fixed exchange regime can also have a very significant effect on the initial condition for industrialization. So the second set of argument is based on accepted results from the literature. So as you know, fixed exchange regime have associated with a very significant trade enhancing effect. So we tend to increase trade flows. And also, fixed exchange regimes tend to prevail in the post-Bretton Woods era with, broadly speaking, around 50% of developing countries under a fixed exchange regime, which makes this issue a critical one. So don't get me wrong, fixed exchange rate also have some benefits, but as you can see with this chart, I put few advantages and few disadvantages of fixed exchange regimes. You can see that we build our story using both the benefits and the disadvantage. So the issue is not straightforward, which further motivate the empirical analysis. So we had up two strategies. In the first step, we rely on panel data regressions to uncover the macroeconomic effect of the exchange regimes. And we, in the second step, rely on gravity regressions to focus on a trade channel to see whether the exchange rate regime effects can be observed in the trade flow data. So our sample cover 146 countries, both advanced and emerging and developing economies, from 1974 to 2019. I think I'm a bit running late, so if you, So the basic regressions in the macroeconomic framework is this one, equation one. So we borrowed the equation from the literature, in which the manufacturing share, which is here in proxy by the value added as percentage of GDP, is explained by income, GDP per capita, and square value, as well as population and its square value. So we simply plug the exchange rate regimes and the interaction between the exchange rate regimes and the GDP per capita to see how the exchange rate regimes effects evolve with the level of development. In another specification, we also had some control variable to better insulate the effect of the exchange rate regime. So we are mainly interested in delta 1, which is the impact of the exchange rate regimes, and delta 2, which tell us how the effect is modulated around the distribution of the initial income. So to address issue of homogeneity, in the first step, we rely on 5-year average data. So our exchange rate regime dummy turns out to be average over 5 years. So we have this variable ranging between 0 and 1, with the value of this variable indicating the number of years over the 5 years under fixed exchange rate regimes. In the trade framework, we focus on the manufacturing share in total goods import. Okay, so we rely on the basic structural gravity model with a number of fixed effects. We include the bilateral exchange rate regimes as well as the interaction to see how these effects evolve over time with depending on the relative development level. And as previously, we are also interested here in beta 1, which is the effect of the exchange regime for the less developed country, and beta 2, which tell us how the effects evolve as a function of the relative productivity or development level. So regarding the data, a very key point is that we rely on the classification built by Couard and Grekou, which tend to fix a very important issue regarding the exchange rate regimes classifications. As you can see on this table, the most popular classification, the Renard-Rogoff classification and Levy-Yati and Schwarzenegger classification, only agree on 57% of this observation, which is basically close to 50%, which is a very problematic because we cannot derive any strong analysis, any robust analysis. So to circumvent this problem, Couard and Grekou developed a synthesis classifications based on Renard-Rogoff and Levy-Yati classification, harmonizing the framework to derive the exchange rate regimes classification consistent with the harmonized framework. And as you can see, the agreement rate is quite strong, so we rely on this synthesis classification. So for the exchange rate regime classification, it's very simple in the macroeconomic framework, but for the bilateral framework, we need to derive bilateral classification. So we use the initial dummy as well as the reference currency provided along the classification to derive the bilateral classification. And we also make a side step compared to the literature in that we also focus on both the direct and the indirect relationships between the different classification and introduce the notion of peg network. A peg network can be illustrated with the chart. As you can see here, country B and country D share a fixed exchange regimes. Country E and country C share fixed exchange regimes. They also, B and C also share a fixed exchange regime with country A. So a peg network will be formed by all these countries, sharing both direct and indirect. In contrast, country A is not part of this peg regimes. So we use this and build a dummy variable for for the bilateral classifications. So this result shows the our basic macro results. So in column 1 and 2, we do not include the interaction, so the exchange rate regime effect is simply the average effect. As you can see, the coefficient is negative and significant, highlighting a negative effect of the exchange regimes. And when we include the interactions, the coefficient remains remains significant and negative, and the interaction term is positive and also significant, illustrating the fact that the negative effect decreases over time. So we illustrate this effect running few simulations for 2 identical countries sharing the same characteristic but different exchange rate regimes. And as you can see, for low-income country, fixed exchange regime is associated with the cost, so they display lower manufacturing share. But from the bottom to the top of the distributions, as you can see, the relation reversed. You vanish for a middle-income country, and for the top-income country, you can see that they actually benefits from the fixed exchange regimes. So this is one of the most important results in this paper, because it highlights the different nature of the trade-off for the choice of fixed exchange regime. The low-income country suffer from the fixed exchange regime, but more advanced economies benefit, namely through the fact that they satisfy somehow the manufacturing demand addressed by low-income country, which they share a peg. We also run the gravity model, as I said. So we run the basic structural gravity model with PPML estimates, and also the same thing with PPML estimate and cluster bootstrap robust standard error with different type of clustering, the Uber-wide clustering, the country pair clustering, directional, and the freeway clustering, so importer, exporter, and time, which is very, very restrictive. I'm running late, so I will jump to the main result. First, as you can see here, a negative relationship for the relative GDP per capita. So the first slope is negative, the second slope, the square value is positive. So somehow, both the macroeconomic data and the trade data tell the same story. As you can see, manufacturing share increase in the first stage and decrease in the second stage beyond a certain level of GDP per capita. And in the meantime, as you can see, the import share of manufacturing goods in total imports tends to decrease. Then, after a certain level, for more advanced economies tend to increase. So both the story are the same with both macro and trade data. When we look at the exchange regime's effect, as you can see, we have a positive coefficient here, which tends to be not significant in this case. But since the literature mainly favor this country pair clustering, we will consider that this coefficient is not significant. It doesn't mind for us, and mainly focus on this one, where the exchange regimes interacted with the relative GDP per capita is associated with a negative and significant coefficient, reflecting the fact that less developed countries, tend to import more manufacturing goods from advanced economies with which they share a fixed exchange rate regimes. So simply put, the fixed exchange regime act as a suction pump for manufacturing goods. So yeah, we also run a number of sensitivity and robustness analysis, namely by development, splitting the sample by development level, a number of robustness tests, namely the data. We use annual data instead of 5-year average data. Everything works perfectly. Addressing the issue of outlier, using alternative data, running placebo tests to have a causal interpretations of our result. Same thing, results work fine. We also perform robustness tests regarding the estimation procedure, namely time varying parameter, and also run basic OLS as well as GMM estimations, and also considering the manufacturing employment share instead of the manufacturing output share, and everything works perfectly. So I will stop here, and if you have questions, we'll show you the different results in more details. Thank you.
Okay, thank you, Kai. The discussion is not here, so the floor is open for question.
Thank you for your nice paper. I suppose the striking takeaway is the crossover point between your fixed and floating exchange rate regime. So if I push you harder on that, what's your underlying interpretation? What's the causal driver of this crossover point? It's clearly driven partly by income per capita. And what you've got to the kind of the right-hand side, where the fixed exchange rates are dominating, you're going to be picking up an awful lot of euro effects there. The eurozone is probably dominant there, and if you look at the lower end of per capita income, you're going to be clustering around, for example, the CFA franc zone. You're going to find a lot of the smaller kind of lower income countries, say in the Caribbean, the fixed exchange rate regimes with the dollar or pegs, etc. Where certainly for those very small countries, you know there's going to be a large service share in economic activity because they're basically tourism and remittances and various other things. So I guess I'm asking you, can you sort of make a case that there's something other than a compositional effect going on in that story? Can you say something about whether this is a macro-discipline story that you mentioned earlier? Is it about responsiveness to shocks, real exchange rate misalignment, all the kind of stuff that Danny Roderick would talk about in terms of real exchange rate misalignment and the growth of the manufacturing sector? Thank you.
Yeah, thanks for the presentation. Mine is a relatively simple question. You just mentioned South Korea, Taiwan, China, like a number of industrialization success stories. And I just wanted to get your sense of the exchange rate regimes in those countries. Because I believe, for instance, South Korea had some peg towards like the US dollar and then like an average of other currencies. And just how does that complicate your story, like the relationship between exchange rate regimes and industrialization? Yeah, thanks.
Yeah, thanks a lot. Yeah, fascinating paper, eh? Well done. I was just trying to relate your data to what we know about the African context and industrialization in the African context. And whereas, of course, exchange rate regime is an important, say, explanatory factor in industrialization challenges in Africa. But I still find that when I look, for example, at our East African context, which is where I'm from Kenya, so the manufacturing sector and industry more generally is something we've been thinking about a lot, because industry share as a percentage of GDP has been declining despite quite a number of efforts to try to promote industry in different ways. And we've sort of, thought about it in terms of a number of ways. One is industrial policy. If you look at countries in the region that seem to be doing reasonably well in the industrialization context, like Ethiopia, for example, Ethiopia has a more defined industrial policy, despite for a long time having a fixed exchange rate. In fact, they liberalized just last year and the exchange rate really depreciated as a result of that. So I think we find for countries having or not having a coherent industrial policy, I think is a major driver of whether there's an impulse to industrialization. Some of my own work shows that also ability to innovate is a critical driver of performance of this sector, in addition to exchange rate. So you'll find in many African countries, for example, the manufacturing sector has not been able, despite some support, despite infant industry protection and so on. More generally, there are only rare examples of countries that have been able to really innovate in a sustainable way in terms of product and process innovation. But also that's reflected in the fact that very few African countries have been able to enter global value chains in industry. Maybe they're entering too late in many cases, when already many other countries, especially from East Asia, the ones that you mentioned, already entered global value chains. In fact, now, with the African Continental Free Trade Area, the focus now, because one of the big sectors expected to gain is manufacturing, the focus now is on entering regional value chains very strongly. So do you think that difficulty or late entry into global value chains, or attempt to enter, is also a critical contributing factor? I find that the exchange rate regime is important, but I find there are many other contextual factors, I think, that contribute, which are not so easy to control for when you're looking at manufacturing performance in Africa. But good paper, thank you.
Thank you for your very interesting question. So the first question is on the potentially composition effect, explaining my result. We address this issue by running different robustness checks, splitting the sample by a country group. I can show you some of the results. First, by development group, as you can see, the effect is very significant in developing country, also in emerging but not in advanced economies. Splitting by region, as you can see, significant elsewhere, but not in East Asia and Pacific, as well as in the MENA region. We also run a number of robustness checks, excluding outliers, so excluding country with very weak manufacturing share and very high manufacturing share, excluding also country with very high service share, controlling for service, using another database from a published paper in the IMF Economic Review. We simply plug the exchange rate regime variable, and we still observe the same effect. I can show you the result. So as you can see here, excluding the outliers, we still observe the same thing. Running with the alternative data, we still observe the same thing. So, of course, I cannot exclude that we have a strong composition. We have potentially a composition effect, but we did the necessary to limit this issue. And in terms of the crossover points, what I explained is simply for me is the fact that these advanced economies benefit somehow satisfy the manufacturing goods demands from country developing country with which they share a peg. So simply put, manufacturing goods demand from Côte d'Ivoire, from Benin, from the CFA zone is mostly satisfied first by country in the Euro area, produced in the Euro area. So Germany, France, and this other country. And the competition between these producers for more advanced economies and any initiative coming from this developing country in the CFA zone will only lead to a failure of industrialization because of this productivity differential, which leads to different significant quality difference in the quality. So the second question was on the exchange regimes in Asia, and somehow it's rather consistent with the third question. Yes, exchange regime is not the only explanation for industrialization failure in this country. Of course, it's for me it's a very important part, but it's not the whole story. You have to pursue an industrial policy which is consistent with your exchange rate regimes policy. If you want to develop based on the famous export-led growth theory, you must have the consistent exchange rate regimes going with your policy. China, for instance, adopted for a long time a fixed exchange rate regime, then tends to an intermediate exchange rate regime vis-a-vis the US dollar. This is so because they wanted to maintain some competitiveness. Okay, so you cannot, if you want to develop with industry. So the very important point is competitiveness, is cost, and all these different things. You can still have a fixed exchange regimes and significantly increase your manufacturing share. But I mean, it has to come from the industrial policy first, and then you plug the exchange regimes inconsistent with your industrial policy. And to conclude on this point, the main takeaway from this paper is that okay, you can choose a fixed exchange regime, but mind the industrial cost. If you want to benefit from the fixed exchange regime, make sure you limit the cost of the exchange regimes. And this cost is mainly industrial, as I show you. If you want to increase trade and that you are a developing country with no industry, you should not choose a fixed exchange regime if you want to increase trade, because you cannot transform commodities. You need to have an industrial policy which is consistent with your exchange regimes. So, yeah, that's the main point. If you want a fixed exchange regime, make sure this is consistent with the development of trade, so the building up of regional trade channel. And to conclude on the third point, yeah, I fully agree with you. Exchange regime is not the only explanations. You have all the financing capacity constraint, all this political will also to industrialize a country. So yeah, it's not for me, it's definitely part of the story, but it's not the whole story to explain industrialization.
Thank you.
Thank you.
Okay. Thank you very much, Carl and Mr. Thank you everyone for attending this session. My name is Tewodros. I work for the International Growth Center. This paper is a joint work with Hanna Oldekidan and Affroumou. It was a response to a policymaker request to see if a relatively competitive Treasury bills market can give us a signal or can serve as a benchmark for interest rate-based monetary policy in Ethiopia. So it can be a little bit context specific, but I think I would appreciate your feedback and your outlook on this one. Thank you. So there is, in the literature, there is sufficient evidence that Treasury bills can impact monetary policy. We can have different types of monetary policy, quantity-based, interest rate-based, and inflation targeting modalities of monetary policy. In several of these, in most of these monetary policy regimes, we can use different instruments depending on, of course, the framework. We can use open market operations, required reserves, and sometimes Treasury bills, which are sort of a tool for the central government to raise funds for its own use, can be used when it's managed by the central banks to affect it affects the amount of liquidity, because when the central bank issues Treasury bills, then it collects liquidity or money out of the economy to the central bank, which can affect liquidity in the system. So it can be used to mop up or inject liquidity. There are some central banks who use that. It requires sort of coordination. So the case I'm going to be talking about is the case of Ethiopia, the country reformed its treasury bills market, made it more market-based on the yields in 2019. So it managed to get better yield signals coming from this market. Now the question was that can we use the yield or the interest rate that we see in this market to serve as a benchmark for a possible interest rate based monetary policy going forward. So we were asked to sort of empirically assess whether we can use these interest rates, are they useful for monetary policy is the question. So by way of just sort of setting the scene, in the theory, budget deficits can be covered. Government covers its budget deficit through different instruments, and it can issue short-term and long-term instruments. The short-term ones are usually treasury bill or money market instruments. Supply is mainly determined by funding needs of the government, of course, as the government issues these instruments, but the demand is mainly determined by short-term money market drivers like excess liquidity in the banking system or yield. So central banks also issue other money market instruments for their own liquidity management. It's important to coordinate these and see how this treasury bills markets affects other, money market instruments that are issued. So there is interlinked demand drivers for central bank instruments and treasury bills. In this case, the way the framework we use focuses on sort of the liquidity need of holding such instruments and whether there is some substitutability there. So we starting from the money demand equation that we know interest rates have sort of the negative, effect on money demand while income has a positive effect. A portfolio choice model also includes factors like wealth, risk, and liquidity and other assets to explain the demand for holding money. And now we're going to focus on the liquidity needs, the liquidity motive of holding money to try and tease out these two, the effect of treasury bills, whether we can use it as a benchmark for monetary policy, interest rate based monetary policy. So we sort of employ this new model framework that uses an elasticity of substitution kind framework between different cash and near cash assets to see if the holding treasury bills is substitutable to holding other assets. Here, this is the sort of the liquidity equation that sort of looks at the substitutability between deposits and bonds. Here, bonds, we are substituting bonds to mean treasury bills here. And the parameter of interest here that we are trying to estimate is rho, in which if this is closer to 1, we will have a perfect substitutable between the treasury bills and other deposits. And if it's 0, we don't have any substitutability. I will just skip this one because it's fairly a literature review. In Ethiopia, there's some literature, but not much focusing on this kind of substitutability of treasury bills with other. So let me just set the scene a little bit for you because it's important to understand the context, to understand the results that I will be showing you later on. So until 2020, monetary policy framework remained quantity-based in Ethiopia. So the target was monetary aggregates, intermediate target was broad money, and operational target was reserve money. So it's a fairly rudimentary, monetary policy framework and targeting. And the central bank's mission was price and exchange stability, sound financial system, and contribute to rapid and sustainable economic development. And this mission of the central bank has come in question before because it has two seemingly conflicting kind of mission and objective, namely stability, price and exchange rate stability, which can contradict or conflict with rapid and sustainable economic development, which has been a bit contentious in the Ethiopian case, where government, in its aim to sort of promote rapid and sustainable economic development, compromised stability and sometimes compromised development to achieve the objective of price and exchange rate stability. Treasury bills were established in 1993 and in Ethiopia with a maturity of 91 days initially, and then currently there are 4 types of treasury bills: 28 days, 91 days, 182 days, with a maturity of 364 days. They are issued on a bi-weekly basis, and until recently failed to attract diverse participants. Only pension funds were buying treasury bills, and that's only because pension funds were in their establishment, because they're government influenced. They were only allowed to purchase risk-free asset, which so they're almost forced to. It's way below, the returns are way below the deposit rates, so they would rather keep it in the banks rather than buy treasury bills. But since 2019, when it was sort of liberalized, then banks started purchasing treasury bills, and then of course the yield improved to above at least 2% above the deposit rate. In 2021-22, treasury bills became important since its liberalization to cover deficits. About 70% of government deficits were covered using treasury bills, given that they were more liquid in the market and there was significant demand for them. Of course, they help control inflation because they reduce the resort to direct advances by the central government to finance its deficits. So, as I said, prior to 2019, commercial banks' participation was low, and now I think it's a little bit more robust. I think bank participation has increased and reached by 2023 35%, and average yield, of course, increased to 9.2%. Again, this is sort of, there are also some accompanying reform measures, not just the treasury bills. So there is a new monetary policy framework that wants to move to an interest rate based, from the quantity based to an interest rate based monetary policy. And these reforms, have reinstituted some of the markets that were sort of less functional, like the open market operations, overnight standing facility, and lending and deposit auction directives were issued and are now sort of operational. Now the government also has, the central bank also has now a policy rate of 15% to manage inflation. Has come down to about 16%. So since these reforms, you can see that both the supply, demand, and total sold of treasury bills has significantly increased. This is in billions of Ethiopian birr. So it has dramatically increased since the liberalization. Of course, if you look at historically, banks used to be active up until a point where there was significant distortions in the market and the interest rate was very low. So the participation of banks has remained almost zero for a very long time. And now since liberalization in 2020, then that has increased significantly, enabling the government to cover more of its deficit. Of course, short-term assets, or the short-term treasury bills, maturities less than 91 days are more preferred, which means the liquidity concern for banks is also important in the case of Ethiopia, which makes the model we use more appropriate for this exercise. Of course, the rate or the yield has increased to above deposit rate. It's remained less than 2% for a very long time, whereas deposit rates have have averaged between 4 to 6% usually. So these yield rates have increased. Another important maybe indicator is that its share, Treasury bills share in domestic debt has also slightly improved over the past few years. This is the green line. So as I said, we want to really measure whether this rate, this Treasury bill rate that's now more market-based, can it be used as a benchmark for interest rate-based monetary policy? Of course, it is slightly higher than the deposit rate. So can the central bank use it? So we are trying to see if holding a Treasury bill and putting it at the bank are substitutable. This is a framework developed by Krishnamurti and others in 2022. When rho is 1, when this parameter is 1, the equation shows perfect substitution between government bonds, or in this case, Treasury bills and deposits. So if it's 0, neither substitutes are complementary, and when rho is less than 0, it means the two are complementary. So liquidity services is measured by the difference in interest rate between the average lending rate, or in the model it says risk-free interest rates, and the bond rates, and the risk-free interest rate and the deposit rate. Again, it is a typical kind of budget constraint for investors. They can earn their income through putting their money in different assets, in deposits, bonds, through lending and other income, and they're constrained by their spending, which is consumption, investment, and transfers. So investors have a trade-off of earning from lending and liquidities, which is what we are sort of using here, is their appetite for more long-term, putting their money in a long-term assets and earning from that, and whether they need more of the liquidity, and that's this investors trade-off of earning. So if through sort of taking the first order condition, we'll find this estimation equation where we see that the liquidity service is determined by whether banks put their money into bonds or deposits, and mediated by other factors. We will log transform this, and we will have this estimation equation, which we estimate using the ARDL estimation method. So just for the data for liquidity services, it is measured by the difference of interest rate with a risk-free lending rate, but we don't have a risk-free lending rate, which is important in this model. So this is one of the caveats for this paper, is that since we don't have a risk-free lending rate, here we use just the average lending rate. But in Ethiopia, most banks are heavily collateralized, so their lending rate is fairly, we can say that the risk is fairly low, which is why we just take this as it is. In the context of banks and pension funds, have the option of investing in what they say is risk-free assets, which are Treasury bills. We use other covariates to do this estimation. So the period covered is using monthly data from 2014 to 2022, and for holdings we use total stock values. Okay, I'm almost done. 2-3 minutes. Thank you. So it shows. We estimate, because we are focusing on the short-term assets we use just the 28 days and 91 days, and we find that for rho, it is substitutable, or rho is not significantly different from 1 in this case, for the period between December, for the whole period, and for the period before the liberalization. We find that the deposits and Treasury bills are substitutable, whereas in the post after December 2019, in the post period, we find that the two deposits and treasury bills are more complementary rather than substitutes. This was intriguing for us because complementarity, we don't expect complementarity, but I think we have an explanation for this one. So what happened was that treasury bills, when banks started purchasing treasury bills, we expect that it depends on their availability of liquidity in the system, meaning that if they have more deposits by the public, then they will be more liquid, enabling them to put their money in treasury bills, which means that their deposits become more complementary to treasury bill purchases in the market. But in previous times when only pension funds were purchasing, when pension funds, it's a substitution between putting it in as a deposit or buying treasury bills. The public, by law, can buy treasury bills, but it has to go through the banks. But we don't see a lot of data where the public, the general public, actually buys treasury bills, which in our case, this model is more fitting to where a significant part of the public purchases treasury bill, if that was the case. So our conclusion was that in the post-2019 period, ironically, after the liberalization of the treasury bills, it becomes more complementary to deposits, so does not really necessarily reflect or signal to the monetary, for interest rate based monetary, it would not serve as a benchmark, is the conclusion that we have. As a conclusion, then, despite reforms in interest rates have not been responsive and impedes, of course, development of markets, treasury bills are more responsive to demand and supply more recently, have been instrumental in financing deficits, but currently deposits and treasury bills are more complementary and difficult to consider to be used as a benchmark for interest rate-based monetary policy. Again, so it seems we need to sort of encourage more people to, general public, to hold treasury bills more and more rather than just banks and pension funds. Of course, we need to control inflation to make interest rates more effective in the market, and adequate planning in the coverage of fiscal deficits and treasury bills can make it more predictable is some of the policy issues that we raise. I thank you very much. Thank you.
Okay, thank you very much for your presentation. I have two kinds of questions on your paper, but I found some answer of some of my questions during the presentation. Firstly, I have some questions about the structure of your paper. For instance, in your paper doesn't have an abstract. I think that's not abstract in your paper. And also in the introduction of your paper, we don't find the plan of the rest of the work in the introduction. Also, I have some few questions on the, what can I say, on the numbering of a question on your paper. For example, if we look at on page 7 and 8. We find that the two equations are the same number in your paper. So that is the question. Also, I have a question on the number of the table. In the appendix, all the table are number 1 in the appendix. All the table 1, table 1, table 1. I will send you the rest of the comment after. But according the the econometric approach is well constructed. Based on theoretical approach, you develop an ideal model that is good, and you make some diagnostic tests, stationarity tests, co-integration, but you don't realize the lag test to find the number of lag to input in your model. I don't find this in your model because if the number of lag is high, that can, I think, bias the result in your paper. Also, you don't make additional tests for the robustness of your paper. You can, in your paper we put some limit of the VAR model, but I think that the VAR model can also help to analyze this work. About the control variable you use in your paper, I don't see, for instance, regulatory framework about institutional in your paper. I think that this variable is important for this analysis, and I would like to know if institutional barrier does not exist. Institutional barrier in your paper, you don't discuss about the role that can have government in this paper. Also, I think that the result you find in the case of Ethiopia can make some comparison from another country that has, I think, input the same reform with you. You don't discuss, for example, I think that Ghana experienced this same thing. So I think that you can discuss this result comparatively to the case of Ghana to show if we have some similarity between the two cases. Yeah, I will send you the rest of my comment after. Thank you.
Thank you very much. Do you want me to respond? Okay. Thank you, Tiemele, for those comments. Sorry about the sloppiness of the paper. It's a work in progress. So some of the abstracts, question numbers, table numbers, well taken. I will correct that. We did a lag test, and we found that 2 lags were the right. Maybe it was not very clear in the paper. I will make sure that it's there. I will check. I will do robustness tests using VARs and other models. Except this framework may not be in line with the framework for that estimation for that VAR model. But I will definitely check that. Regulatory framework, of course, I separated the periods of where that regulatory change happened and estimated separately. That's why I did not explicitly include it in the model, but we can see that. I'll see if there are other institutional barriers that I can control for. It's a monthly data. If I can find institutional barriers, I'll definitely include that. I have some in the literature review. I have definitely included some country cases, but not countries that you mentioned like Ghana, who went through the similar kind of reform. So definitely, I will do that. Thank you so much for the comments. Any questions? Chris.
Thanks a lot. It's a great paper. I think good potential, and of course studying interesting issues because Ethiopia now is in a period of reform, quite critical reform. So I think you need to think about some of these issues. Just maybe a few comments from the Kenyan experience with some of these issues is I think you need to work towards having a benchmark rate, benchmark policy rate, some kind of central bank rate, probably, so that, especially because you're moving towards an interest-based system, inflation targeting, where you're going to give quite some prominence to that. So I think it's very important for the central bank, especially now that you're moving towards a more liberal view, to have a benchmark rate for your monetary policy. The the challenge with relying on treasury bills is as sort of benchmarks is the problem of fiscal dominance in many countries, and that's something that I thought maybe you need to look at some interactions from the fiscal policy side as well, because one of the main challenges you find is that the way treasury bill rates move is influenced a lot by the government's domestic borrowing program and how that changes. Yeah, so you find that for example, if the government has an aggressive domestic borrowing target, then this tends to put upward pressure on treasury bill rates. If it relaxes it, then that tends to put downward pressure on treasury bill rates. So there's a lot of influence from the fiscal side, whereas in an inflation targeting regime, you want also to kind of have a little bit of independence from those factors, whereby maybe an inflation target is set, and then the central bank has the primary mandate of working towards that inflation target, and issues of fiscal dominance are avoided to the extent that is possible. But I didn't see you mentioning so much about level of fiscal dominance in Ethiopia, maybe what are the fiscal monetary policy interactions, because I see that somehow seems to be something that's in progress. Something else also, maybe from the Kenyan experience, is what we did eventually when we had a process of almost a decade of transition into an inflation targeting or interest-based regime. It was a slow process. Started around 2012, something like that, as we institutionalized the Monetary Policy Committee, and then over a decade we're making that transition. And then recently, you could say about 2 years ago, we fully made that transition. And a very important aspect of that was we came up with a monetary policy framework in line with inflation targeting, where we had an interest rate corridor as well around the central bank rates, so as to enhance transmission. Because once you have a benchmark or policy rate, then your concern becomes how do you enhance transmission of that to the rest. So the approach we took is we had an interest rate corridor, and then what happens is the monetary policy operations on weekly basis try to align the central bank rates with the operating rate, which is the overnight rate, which is what I see Ethiopia is also moving towards an overnight rate as well. Interbank kind of rates. So I think just see how you can introduce probably the fiscal policy interaction maybe into the equations, because that I think is very critical. And of course, yes, there's some substitutability. I know you're looking at that, some substitutability between the deposit rate, between the treasury bill rates. You find some substitutability, you also find some complementarity. That's expected. I think one of the issues you're going to see, happening over time, is that commercial banks also, the deposit rate for them is a cost of funds rate as well. It's a cost of funds rate. So they tends to be asymmetric kind of response. When rates go up, they're quite quick to adjust. When the central bank goes up, when the central bank rate goes down, they're much slower to adjust. So in time, you're also going to see some asymmetries coming up there. Yeah, but I think maybe more, because you're moving towards an inflation targeting regime, I think maybe also look at some of that literature, compare, of course, to the monetary aggregates approach. So look at more of that literature, see which kind of countries might be useful comparisons as well for Ethiopia to look at. But I think generally in terms of monetary policy and which rates you should actually target, I think the transition has to be towards a benchmark rate eventually as you develop different types of instruments. I don't know whether you mentioned, well, initially it was Treasury bills were limited more to the pension funds. I don't know whether you're thinking of opening up in Ethiopia also this to foreign investments, because in Kenya, for example, what we've found, some of the biggest investors in government paper also tend to be the regional pension funds as well, not just the ones in Kenya. So I don't know about that dimension of opening up the market as well to foreign investors, and then the potential impact that will have. Because once you do that, then you need to consider other types of things. But otherwise, good paper, good direction.
Thank you.
Well done. Thanks.
There is a.
Sorry, this is not a question, but I was just thinking. He was asking. He was suggesting for you to focus on the effect of government spending. So I was just thinking, isn't that perhaps captured in the bond purchase that you showed in the budget constraint? Government spending is serviced by borrowing. So I'm thinking perhaps that purchase of bond would capture the effect of government spending in that sense.
I think there is a question.
Yeah, the issue is that the target keeps changing very often on domestic borrowing. The spending can be there, but the target changes from time to time.
Thank you. Really nice paper, Teddy. Just a couple of observations. So you've got these two players in your model. You've got the non-bank financial institutions, and you've got the banks. And the banks are they're holding the bulk of these bills. And the way you set up the model, the Krishnamurthy framework, it's drawing you into a non-bank financial institution framework. It's saying, here are these financial institutions, and they're thinking about their asset book, deposits, bonds, and other assets. But that, if you think about the same framework for the banking sector, I think the really interesting question is it's their asset side that you're focusing on. And their assets are going to be bills, bonds, other gilt-edged securities, lending to the private sector, and then their kind of cash liquidity. So in a sense, their story is a three-asset, roughly speaking, a three-asset kind of preference, a portfolio preference. And what we do know is that, and historically across the region, banks are holding an awful lot of non-interest-bearing liquidity, just deposits, reserves, some of them statutory, but there's quite a lot of excess liquidity above that. And I just was wondering whether you would get more of an insight if you kind of separated your estimation between the non-banks and the banks in the first instance, and then for the banking portfolio setup, it's actually a three-asset. You can use the same sort of framework, a three-asset portfolio where you're looking at the choices. Now, the interesting question is, and it's always the case in all of these types of approaches, why would any institution hold excess cash when there are interest-bearing alternatives available, especially ones that you're claiming are risk-free? So it's true that they're earning a negative real return, but they're earning a positive nominal return that exceeds that on cash. So there's a question about rethinking the notion of liquidity here, because clearly you would expect bonds to just drive out or drive cash to its absolute statutory minimum as required. But we know that excess liquidity is just a structural characteristic of the banking system in many countries, and particularly in sub-Saharan Africa. And it seems to me that becomes the really interesting story about this kind of liquidity framework. What is it that is encouraging banks to hold excess liquidity? What is it about the bill market, about the liquidity or the thinness of the bill market that means that they don't completely dominate cash here. And that there's a lot of other factors involved here, but I think just framing it in those terms might give you a slightly better insight into the kind of the key results, which I worry are an aggregate of a non-bank financial sector and the banking sector itself. Thank you.
Maybe. Is it?
Yeah.
I think we need just very quickly because.
Yeah. Thank you, Katie. I think my comment is a bit related to the previous speaker. So maybe it's good to look at differently because bankers, they participate in very short-term maturity, like 1 month, 28 days, and pension funds, they participate in longer-term maturities, and the interest rate is really different. And not sure how significant the amount that banks purchase could explain the complementarity, or maybe you can also look at the amount that banks purchase, like treasury bonds, because they are kind of buying 20% of their fresh loans. They invest in the treasury bonds. So maybe that could explain the complementarity in the other side. So yeah, we will discuss it.
Thank you. That's very useful. Let me very, very quickly in 2 minutes respond. Thank you so much. Very, very useful. Actually, I should have updated you that in 2024, what you suggested of having a benchmark rate is in place at 15% with a plus or minus 3% corridor of exchange, and some of these instruments, open market operations, are in place. I think it's a very important point that you raised, and I'm going to include in some way. I think including fiscal dominance is important, and Ethiopia is known for the fiscal dominating the monetary for a very, very long time. That has been, going back and forth, especially in this reform period. But it would be important to look at that. Maybe I'll include some deficit data quarterly, which is why I said I was reluctant. This is a monthly kind of assessment. I will definitely try to include that. On the foreign investment in T-bills, interesting as well. Not at the moment open foreign investment as far as I know. So definitely I'll take that into consideration. But fiscal dominance, we need to really look at that to assess. Thank you, Chris. I think you've given me a really interesting idea, very good idea of separating banks and non-bank financial institutions. What I thought about that, but what worried me was this period where banks did not hold any, treasury bills, and I didn't know what to do with that. If I just keep that, it will only be 2 years. And so let's discuss, and you'll give me ideas. But definitely that I need to do at least. Important in a descriptive way to set up that and what that holding is. On your question of why they would hold cash assets, we've been discussing with banks on some of these, is that some of them, it's a very seasonal kind of cash demand from banks. If it is a harvest season, for example, or if it is a tax-paying season, they experience a huge outflow of cash, so their liquidity management capabilities is very low, so which is why they sort of have that sort of excess buffer from what I know. But again, worth exploring a little bit more. Thank you so much and sorry for taking too much time. Thank you very much.
Okay, good morning, everyone. I am Tiemele from CSAE France. This morning, I would like to talk to you about the causal relationship between property tax revenue, urbanization, and income inequality. And in this paper, we focus on the GMM Panel VAR Evidence developed recently by Grekou and Love in 2016. So domestic revenue constitutes nowadays an important things for both developing and developed countries, and there are more things on what they can play to improve the level of tax revenue. But when we make a simple comparison between this tax revenue, we can look at that in all the region, property tax revenue represents a weaker level comparatively to the other category of taxes. So this conduct us to focus our attention on this tax, because we know that in the case, for instance, of developing countries, they are characterized by a high level of urbanization, and with this high level of urbanization can create some condition to boost the property tax base, and we think that can help countries also to make additional source of revenue. But this fact to boost property tax revenue can have also some consequences on income inequality, and so that can, I think, increase or decrease income inequality depends on the progressivity of this tax. So we look at in the literature what some researchers make on this area. We don't find exactly a paper on the relationship between the three variables, but we find some paper on the relationship between urbanization and property tax revenue, some paper on the relationship between inequalities and urbanization, and also some papers on the relationship between property taxation and income inequality. So based on this research, we assume that we can exist a mutual correlation between the three variables. So we look at the case of developing and developing countries, and we can find that in the case of developing countries, the level of property tax revenue is very important comparatively to the other level of income. Also, when we look at, for instance, income inequality, look at lower developing countries are most characterized by high level of income inequality, and also high income countries are also most characterized by high level of urbanization comparatively to developing countries. So we turn to explore what can explain these differences in terms of property tax revenue between countries. Here we focus on just 4 countries: Canada, France, Cote d'Ivoire, and Namibia. And we find that in the case of Canada, for instance, which is one of the countries with more level of property tax revenue, the management of this tax is made at local level. It's the same case in France, and the same case in Namibia. But for instance, in the case of Cote d'Ivoire, where I'm from, we remark that the property tax collection is managed by the central government, and that explains why this level of tax revenue, of property tax revenue, is weaker. So the research question here is we seek to analyze the causal relationship between these variables and to investigate how this relationship can impact tax policies. And we assume that a shock on this on this variable can affect the pattern of the other. So our paper is the first to examine this correlation between the triplet urbanization, income inequality, and property tax revenue, and we use the novel data set developed by IMF about property tax revenue, and also we investigate the heterogeneity between this relationship depending on the level of development, and we use the impulse response function to analyze the dynamic shock in one variable and how this shock can affect the pattern on the other variable. So our data covers 115 countries from the period 2000 to 2018, and we are here 3 variables. So income inequality, from which urbanization defined as the share of urban population, and from World Development Indicator, and property tax revenue from IMF. So when we briefly look at the correlation between the variable, we find that there exists a negative correlation between property tax revenue and income inequality, and a negative correlation between urbanization and income inequality, but a positive correlation between urbanization and property tax revenue. That is the case when we take the full sample and we find the same result when we look at developing and developed countries. We find the same correlation between this variable. So to investigate this correlation between the three variables, we use the PEVA model based on this equation. In this equation, each variable is used alternatively as dependent variable, and the others constitute the heterogeneous variable. And also we use the impulse response function to investigate the robustness of our results. Before presenting the result, we make some diagnostic tests such as unit test, co-integration, and the lag determination based on the BIC model. So when we look at, for instance, here the stationary test, we find that all the variables are stationary. We also find that the co-integration test show that all the variables are co-integrated. And when we look at, for instance, here the number of lag, we find that we will change one number of lag based on the MBIC methods. In terms of results, when we consider the full sample, we find that urbanization influences positively property tax revenue, and we also find a bidirectional causality between property tax revenue and income inequality. Specifically, we find that income inequality reduces property tax revenue, but contrary to our expectation, we find that property tax revenue increase income inequality. And this result, we can find this result here when, for instance, we look at the PEVA coefficient here, that property tax revenue here increase income inequality contrary to our expectation. Also, when we look at the Granger causality, the Granger causality confirms the result found with the PEVA coefficient. So to make sure that these results are valid, we make some additional tests to verify the validity of this test. So we make the agent value stability and also the root of the compounded matrix, and the same investigation also confirm our result of the validity of the test. For instance, here, let me check this. Here we make that all the units are in the cycle. That confirms that our results we find previously with PEVA coefficient and also with Granger causality are valid. And to conclude, we use the impulse response function also to check the validity of our results. And when we look at here, you can find that all the figures here confirm the result found previously. For instance, here we note that a positive shock on urbanization affects negatively income inequality and positively property tax revenue. And here, for instance, we find that a positive shock in income inequality here reduce property tax revenue. And here we note that a positive shock on property tax revenue affect positively urbanization and increase income inequality as we found previously. As additional tests, we split our sample into developing countries, and here we find some heterogeneous results. For instance, our result here, when we look at, for instance, the case of developed countries, we find a bidirectional causality between urbanization and property tax revenue. That can explain that the fact that in developed countries, property tax revenue is well managed comparatively to developing countries. And also, we find that income inequality, depending on the level of development, urbanization reduces income inequality. So, as conclusion, our paper shows that there exists a strong correlation between our three variables, such as urbanization, property tax revenue, and income inequality, and that urbanization not only promote property tax revenue, but also reduce income inequality. That invites practitioners and policymakers to look at more attention on property tax revenue, because this tax is a direct tax, and to make it more progressive, and also to make sure that the benefits of urban planning may be equitably benefit from all citizens. Thank you.
Thank you, Tiemele, for your presentation. The paper is good, very interesting to read. Unfortunately, I have to do my job, so I got a couple of comments. I hope that will help you to improve the quality of the paper. 2 major points. The first one is that the paper is not, to me, is good, but it's not smooth enough. The most important thing is that the story is missing. The story is clearly missing. The motivation, why do you focus on free variable? It's not clear to me. You didn't mention any transmission channels. So yeah, so this is the second point also. You have too many things. You are dealing with free variable at the same time. It's already difficult with two variable. So, I mean, one paper, one story. Make sure if you have free variable, make sure you have the story consistent for all these variables. Another point is that you have some approximations, a lack of precision in the paper. Sometimes you mention when you mention fiscal policy, property tax policy, local government taxations. So be more precise on this. It's the same thing when you talk about inequality. Sometimes in one sentence you have inequality in general, citing a paper on inequality between country or within country. And in the next sentences, you talk about income inequality. So inequality is very multidimensional. So it's very specific and stick to what is consistent with your story. So my suggestion is that you should better motivate your triplet or get rid of it. Just focus on the two variable. And if you want to keep your free variable, please provide us with maybe a table or a chart illustrating what you expect has causality. Since the main motivation of the paper is to analyze the causality. You can have some, maybe urbanizations, income inequality, and property tax revenue with arrows and question marks and what you expect depending on developed country or developing country. I think this would be very important to quickly understand the paper. And similarly, I think you should also build your literature section around your story. You have a literature section with 3 subsections. I think it's two. You've only focused on 2 variables at a time. You need to build your literature review around your story. The second major point refer to the empirics, and this is more like a comment or an open question. I'm not sure that the data fit your ideas, what you have in mind. First, the connection between income inequality and property tax is not straightforward for me. It didn't motivate these connections. You do not, it seems to not take into account some of the data limitations. For instance, the Gini coefficient, you have different distribution that can lead to the same value of the coefficient. You focus on the income inequality, you never mention informality, which is very significant in developing country. So you somehow miss part of the story. And so I'm also puzzled by the level of the analysis or the story. Sometimes it seems that you are on the macro level, sometimes on the micro level, sometimes something in between. And by the way, the dimension of the analysis, is it between country or within country? Because some of the paper you mentioned on urbanization and income inequality, for instance, focus on within country analysis. For instance, people moving from rural area in China to main city in China and the change in the income inequality. Most of the literature is based on this kind of this analysis. So in your case, you tend to move to a between comparison of country, while most of the background, I mean, the literature is based on within country. You also have a quite weird transformation of the data because you use natural logarithms of variable which are themselves percentage. I think you should not. Either you choose percentage and simply differentiate if they are non-stationary, or just logarithm for the value, not both, not logarithm of percentage, because the interpretation is not feasible. And also, this was one of your recommendations. It's just that government should put in place more progressive property tax. Keep in mind that property tax are among the most, the less endogenous tax, because it's scheduled in advance. So government usually don't use it as a fiscal tool. The second major point focus on the method. You use the Granger causality concept, but keep in mind that this concept have many drawbacks, namely the fact that you do not take into account latent confounding effect, and I think your analysis actually suffer from this limitations. And since you are using a PVAR, why not using Sims causality instead of Granger causality? And the last is much more a suggestion. What about local projections or local projection IV, which is very robust to deal with omitted variable. And last but not least, I was surprised to see, I didn't pay too much attention on it in the paper, but it's very puzzling for me. You have all stationary variable, but you run co-integration test and you find some co-integration. So for me, it's not possible. You cannot have co-integration if you have stationary variable. Maybe your time dimension is too weak when you have 19 years. So maybe your stationarity tests have less power, but you cannot have stationary variable and co-integration. So something is wrong with your test or your econometrics. And I will discuss it much in detail with you after, but put every test on the appendix. The paper is already heavy, and the most important figure of the table of the paper, are not readable. So again, it's a good paper. I think you can definitely significantly improve it.
Okay, thank you very much. Just add some elements about this model. So the model here, we use here the model developed by Grekou and al. And the model is based exactly on the model of Sims 1980. So in the model, the command we use allows us to make both co-integration and stationary tests. But in the model, they say that co-integration is not an obligation for them, for the command we use on starter. But I will explore more of this thing. But in our case, exactly, we found stationarity and also co-integration, but I can explore this in more detail. Local projection, I think that local projection in our case is not appropriate for the analysis we want to do. And because about the history we do in our paper, in the session 2, when we make a literature review on the paper, we have some theoretical analysis on the triplet between urbanization, income inequality, and property tax revenue. There it is. But I agree with you that you can improve the discussion about this. But I think that that is the first draft of this paper. I do more now. But also so about the story, I think that now we put more things in the story because I received this comment during my thesis presentation. So I improve this fact. Also about
We can discuss it after.
Oh, you say. So we can discuss after about these points. Thank you very much.
Thank you for your presentation. I think the paper is already very good. I will not go back on the methodological limitation that have already been pointed out by the discutant. Just I want to really emphasize some point, especially the story, because even me, I didn't really understand well what will be the channel to which the income inequality will affect the property tax. And as it has already been said, maybe 3 variables is too much. Maybe you should try to consider one as a conditional factor that could drive the relationship or that can play a role between the two orders, according to the fact that the property tax mobilization is your relevant variable of interest. I also want to say that maybe you should elaborate more on the role of institution. You have spoken about the different ways of managing property tax. So the local management, the central government management, and I think I've missed the explanation of the role of this way of management in the paper. So if you could try to look into that maybe more, it would be good. Also about the IRF interpretation, I think the way is not to say that looking at how the IRF is to confirm or is to affirm the result. You should discuss more about the scale and the persistence of what we are saying, and this should lead you to formulate or to be more precise about the recommendation in terms of economic policies. And finally, maybe I will insist on local projection because it deals well with misspecification and heteroscedasticity problems. So you should maybe try to run it with your data to see if you can use it as a business check for the paper. Thank you for really thanks for the work. It was really good.
Hi, thank you very much for this. This is actually a topic that's really of interest in our office in the World Bank. Actually, my colleague Perijita Goyal just published a book on land taxation in sub-Saharan Africa, and she separated out the chapters between urban and rural because this question of urbanization really is important, and the mechanisms you have between urban and rural for land management are very different mechanisms. So focusing on urbanization is actually quite well motivated. But with that, you have inequality itself is going to be different between urban and rural. And so maybe instead of looking at income inequality, we have other measures of inequality, and one of which is non-monetary measures of inequality, or poverty, sorry. And that, I believe, we've split up between urban and rural too. And that in itself can kind of get to a motivation behind some of the urban land taxation, which is service delivery and governance around service delivery, right? We're creating this dual system in which, people are living in informal housing without access to public services or living without access to sanitation in the large part. And this is a governance issue, right? And this is why we need to focus on property taxes coming through. And so if you're able to kind of bring that in through public service delivery, I think it could make that motivation stronger.
Okay, about the first question. So, briefly, population in urban center increase. Okay, when population in urban center increase, the property tax base also increase. So, governments can put in place some measure to cap more property tax revenue. But the measure they want to put in place can have some consequences on income inequality. It is for this reason that we try to investigate the triplet between the three variables at the same time. That is why we need. Also, when, for instance, government or local government or central government put in place some measure to cut more property tax revenue, exactly they can use the property tax collection to put in place some health services, some education infrastructure, and that can also help to reduce, I think, income inequality. Yeah, I think it is possible from property tax revenue because property tax revenue is a direct tax. The role of the direct tax exactly is to, I think, more progressive according to the household income. So the more you gain, the more we pay. So I think that can help also to address the question of income inequality. I think that might be that is not enough explained in the paper. We can do more, but we have some theoretical example in the literature that we can find around the triplet between this variable. Okay, about local projection, I think that when we do some econometric investigation about local projection, we can have some same graph, such as the IRF input response function. Generally, is the same way we find when we do local projection. I think sometimes it is the same approach because when we investigate local projection, we analyze the shock on the variable according to the time. So local projection, that is an alternative, but I think that can also be near to the IRF model we do. During my presentation, I go very quickly around the IRF, but I think that in the paper, I give more elements about the shock on the time with the input response function. And exactly, we use IRF to make more policies. I think it's all the question. Is it okay with another question?
Thank you so much for your paper. I really enjoyed it. It's not super central, I think, to what you presented today, but just a very small point that you noted Côte d'Ivoire and some of the limitations to property tax being sort of corruption and inefficiencies and stuff. I think the challenge in a lot of countries is to sort out the land cadastral, because that has to come before property tax. You have to figure out who owns what land where. And the challenges of doing that in urban and rural environments is very different as well. But so I agree, but I know that the World Bank in Côte d'Ivoire has been trying to work on this for a long time. And I think beyond just governance issues and like not managing to do things or sort of inefficiencies, I think there's often quite powerful political interests in keeping land ownership unclear, and income inequality can play into that, and there can be big interests in keeping land ownership unclear. And so, I mean, just a point to make that the political economy around land ownership and property taxes, I think, will play in, and inequalities will play very strongly into the results that you're getting on that. So I wanted to flag it from my own research in Côte d'Ivoire.
Thank you. No questions? Oh, you want to?
Thank you. I just want to emphasize the importance of building your story in the sense that if we have some graphs, because in your impulse response function, for example, you said a shocking income inequality, which is something difficult for me to understand whether income inequality, experiences a shock. It seems to be a more underlying fundamental structure that causes that, and it's important to see trends across different countries of these variables, relationships, and as the discussant said, you can always use that as a motivating factor. Look, here is a an inflection point where you see these relationships. Of course, you've shown the sort of those kind of graphs with trends, but it needs more of a more patient. It helps the paper if you could include that or respond to it. Thank you.
Hi there, it's an interesting paper. My work is on taxation, and I was just thinking, instead of you using looking at urbanization, the World Bank have developed, I think, the informality index, which varies actually. There are two indexes from the World Bank which look on informality, and on the issue of urbanization as well. For example, I come from Tanzania, where the way the government tried to onboard taxpayers, especially on property tax, is to distribute the tax through your electricity purchase. Then if you have an assertion that maybe urbanization matter, in the context of Tanzania, maybe urbanization will matter because so long as you have your house and it's connected to electricity, you will pay property tax. So that I'm not sure how that play out in terms of the urbanization story. Thank you.
Thank you. Yeah.
Just point I forgot to mention. Yes, just a small comment. Sometimes in paper you can choose between residential tax and property tax. So make it clear also in the paper.
Yeah. In the case of our paper, we use the total property tax in the country.
Yeah, but by the narrative.
Okay.
Sometimes you say you can choose between residential tax and property tax. It's completely different.
Okay, thank you. Okay, thank you very much.